Hello, everyone. Welcome to our webinar in English. We're very proud and happy to do this first webinar in English with you guys. So for those that don't know me, my name is Daigneault from Daigneault Advisory Group, and we've been doing webinars for the last couple of years and on different subjects. So we thought this one would be pretty special due to the market conditions that we've lived in 2022. So we call this our opinions on the financial markets. So as far as the disclaimer is concerned, we just want you to know that this is our opinion and based on information that we believe is pretty accurate. So, you know, we all know that in a market cycle, there are an expansion period as well as a recession period. But more so, there's also emotions. We've all heard the expression about that once we've hit the top of the market, we don't like the market to go down, so it's called the loss aversion bias. And we just want you to know that we do understand, and that basically when we look really at the market, we're talking about ups and downs. And ups and downs, when the market goes up, it's quite fun. When it goes down, it's not as much fun, and that's where the emotions get into play. But what we wanted to show you here is that often we lose track that if we go back to 2008, the last big recession, which was the second largest recession after the Big Depression, we see the ups and downs of the market, and sometimes we forget, and we always say that an image is worth 1,000 words. Well, that's what we believe it is. For the past really 12, 13 years, there have been many crises, that it be geopolitical or else, but there's been quite many ups and downs. But if we look at the tendency of the market, and that's why we always say on long term the market always goes up, and that's what the red line is. And what we used here is we've talked about the US, the S&P 500, which is really the index that we follow. Even as Canadian investors, simply because it's a broader market, it's many different sectors. It's more representative of what an economy is, and that's why we always refer back to the S&P 500. In the news, we will be talking about the Dow Jones, but the Dow is really used to be an average, but it's still only 30 stocks. Fairly diversified, but we prefer to follow the S&P 500 simply because it's the 500 largest corporations in the US. So through this, we see ups and downs, and obviously since 2022, we saw the big drop on the market due to the war in Ukraine, obviously, and lately, and we'll spend a little bit of time talking about some of the items like inflation, but lately in the news we're talking about the soaring inflation. But where we're at, that's what we're going to try to discuss. But long story short, often people ask us, well, should we go cash or not in the portfolio? And we always say no, we don't want to go cash, simply because we don't know when the market's going to go back up. And and it was interesting to look at the past month and a half in from October to November, how much the market has pushed up. And I'll finish the presentation with a little comment based on that. But we do understand your emotions. We get them, we feel them. But one thing we try to not do is get emotional about the market, and that's why we always go back and talk about our process. It's based on an institutional, it's asset allocation. You will hear us talk about asset allocation all the time because it's where we move the money, or which asset classes we move the money from, but being pretty much fully invested. And if we look at the market, at the picture here, if you would have stayed in the market, and we understand that each person is different, a person that's retired that needs to withdraw money from their account will not have these types of returns. But basically, it always goes up, and that's what we say through the ups and downs. And there's been the COVID one, there's been this 2022. Overall, a person that would have stayed invested since the last recession up until today, they would have done over 12% on the US market, which is a pretty decent return when you look over overall. So we need to be patient, and that's what we're going to try to cover today, some of the items. So when we talk about emotions, we really mean seriously that we feel your emotions. There are a market sentiment that early February, when the war in Ukraine started, there was an extreme pessimism. And to be honest with you, February was low, but it was not the lowest we've seen. April or May was the lowest we've seen in terms of extreme pessimism. And as far as we are concerned, whenever there's extreme pessimism, we often say to people, there might be great opportunities out there. So this portion of the market sentiment, when people are really just want to go cash, just want to sell, that's probably where the biggest opportunities are. And we'll look at that a little bit later on. But last week, if we look at where we were at, the emotions, people were starting to feel a little bit more optimism about the market. It's simply it's simple due to the fact that when the market goes up, people are really comfortable and makes it more easy to just say, oh, phew, we're out of the recession, or we're out of where the market, from the bottom of the market. Actually, we just want to look at one other element, and we just want to make sure that you understand that whenever there's ups and downs in your emotions, we feel them, we understand them, but we try to be rational about it. So what we're going to be talking about today is I'm going to cover a few things. Let me just make sure that I put them all in order. So we're going to talk about, obviously, the inflation. I mentioned that a little bit earlier. And we're going to do a little wink to gold. We often get asked a question about why don't you invest in gold, and we'll show you one of the reasons why we are not too comfortable. We're not saying it's not a good sector to be in, but the reason why we normally don't invest too much in gold. We're obviously going to look at the interest rates and the impact that it has had on the bond market. And obviously, we'll look at the recession, the signs of recession. So there are many elements. There are some a few items that we need to look at. And are we heading into a recession or not? Now, there's a debate for a few reasons. We're going to look at the consumer spending as well as the supply chain, which it's been in the news for the past year or so. After that, based on all these elements, we're going to concentrate and see where we are investing through our asset, through our portfolio, which asset class we are starting to look interested in, or we are interested in, and since when, and the reason why. So, and we'll again do a little wink at the GICs because we often get asked the question that while rates have gone up, GICs are interested. There's a sure thing, they're guaranteed. So we'll look into the reason why we're not as fond of GICs unless for specific objectives. So without further ado, we have to go back a little bit in time and see, so what has the market done in 2022? Now here it's as of October 31st, I believe, the numbers. So this is the performance, and it's a gross total return from a balanced portfolio. Balanced portfolio being close to 50% stocks and 50% fixed income. So we can see that it grows, no fees taken out, has been a minus 10% performance. Which, if you look at it just in absolute numbers, we know that we don't like it. We don't like when it goes down. But the interesting thing this year, where normally the fixed income portion of our portfolio protects the portfolio, it did not do its job this year. So we're talking about the bond market. So we'll talk about the interest rates a little bit later on, but as rates go up, bonds go down. And it's a concept that's very difficult to understand for most people. After 20 years, people still ask me the question, why? Because rates go up, we should have a better return on our bonds. It's true, but the ones that we hold in our portfolio, it's not the case. So as bonds go up, it's the same thing as real estate. And today we won't talk about real estate because we get questions about the future of real estate for the next 5 to 10 years. But as rates go up, bonds go down. Same thing with real estate. That's why that when rates go up, the value of the real estate goes down because it just costs more, but it's inverted compared to, it's an inverted proportion to what the rates go up. So when rates go up, bonds value go down. We see that the Canadian market so far, and it's even better now as of today, the S&P, the Canadian market, has done the best market in the world, the S&P 500, and we're bringing it into Canadian dollars. We'll just touch base on the currency a little bit later on because we do not manage based on currencies, but short-term tactically, we can do some moves, which we did this year in your portfolio. And the international portion. So anything else that's non-North America goes into the international market, including the emerging market, which, as you can see, has been quite down. So are there opportunities? We're going to talk about it. And the multi-strategy, the alternative strategy, is something that doesn't move according to the rest of the market. So normally, there's two objectives. One is to have a fixed yield between 5 and 7%, and the other portion is to be non-correlated to the other asset categories, which are either stocks or bonds. So as you can see, it did a pretty decent job, but it's still negative. So we were not protected so far since January 1st in any asset categories. On this, when we say that as rates go up, there has a big impact on bonds, we just wanted to show you with a decline, the stock market decline of more than 20%. That's an indicator of that we're heading into a recession. But the last, since 1990, but the last four major recession, which was obviously 08, early 2000, the pandemic of 20, and the current, I'll say, decline of the market. When we look back, normally the bond market protects us. So this here, it's these numbers here that you see, the stocks, it's a little bit red. I'll go to 2000. The stock market was way down. It was not the end of the year return, but it was just the peak of the downside of that year. During that period, the bonds had protected pretty well. So that's why we believe in diversification. That's why the pension funds are all diversified, and we'll talk about it a little bit later on. But we can see that normally the bond market protects. In 2020, it did not. In 2022, it's the worst year of 40 years, of the past 40 years. So it's something that's really unusual. It doesn't happen too often. The beauty of it is that we are not expecting to continue going that route. And there's a few reasons why we're going to talk about it a little bit later on. So very disappointing in terms of return. It's simply because the protection normally that we get from fixed income or bonds has not done the job. So you've heard of it. It's in the news, it's everywhere. That's the Canadian inflation at 6.9%. That was the latest number that we had. There are two numbers in North America. We sometimes exclude food and gas. So we just want you to know that we do look at the tendencies of both types of inflation, but we concentrate on the total CPI, which is a total inflation of 6.9%. And as you can see, US is a little bit higher than us, but on both charts, what we see is that we've seen to hit the peak of the US inflation. And the beauty of it, yesterday, Powell, the Fed, the chairman in the US, was talking, and you saw automatically when they talk, it's short term. He mentioned that there might not be as strong of rates increase moving forward as it was since the beginning of the year. I think they had to do it. My opinion on it, and it's really just an opinion, is I think they were a little bit too slow acting about increasing rates. I think in 2021, we could sense that the inflation was starting to boil over a little bit. It would have been fun to already increase some of the rates in 2021. It was not done. So basically, they had to push hard, increase rates hard, and we can see it really when the spike is going up. The beauty of it is that we see starting to decline. So that's the good news, and that's why I believe, and we believe that the inflation has peaked at this stage. Does that mean that the inflation will not stay high for a while? We believe it could stay high for a while. The central banks throughout the world want to make sure that they are that they've solved the inflation, they've controlled the inflation. But the beauty of it is that the way the inflation is calculation, it is an average of the past 12 months. But if you look month year over year, so November 2022 versus November of 2021, it is normal that the inflation number in 2022 is higher because in 2021 it was much lower. Now, the comparison looking forward will be that we were very high in July and August and September, and in 2023, moving forward in 1 year, these numbers will be compared to this year, which were almost not historically high, but fairly high for the past 20 years. So that will be really interesting, and that's why we believe that it's subdued now. It's kind of controlled in terms of the inflation in North America. The central bank for the past 20 years had given themselves a mandate of keeping the inflation rates between 1% and 3%. They've done a pretty good job. Like I said, 2021, we can criticize and just say they probably should have increased rates a little bit, but they've done a pretty good job. And their mandate, and that's what they're telling us, they want to lower back to those levels moving forward in 2024 and 2025. So if this inflation is subdued, is controlled, and we are heading either in a slowdown or a recession, which in our opinion, we are, then in order to get the economy going again, we might, or the central bank might have the choice of bringing the rates down. So that's why we're kind of excited looking forward for the next 12 months, and we'll show some of the numbers why we're getting excited. It hasn't been a fun year. It's not a fun year, but so far, it's not as bad as we thought it would be. So we'll see what the month of December is, but it's going to be an interesting year. It was an interesting year. Moving forward, the next 3 to 6 months, we think that we need to be careful because there are elements that we're going to talk about, the inverted curve rates. We're going to look at it, but basically, the central banks, they've increased rates drastically. They want to control the inflation. If the inflation is controlled, we should be heading towards a more reasonable inflation. And let's be honest, if we go back and we'll look at the numbers, if we go back in the 80s where inflation was very high, today they've done a fairly decent job of controlling the inflation. Now, just a wink why we talk about gold as safe haven. The question why we say this is that often gold was supposed to be a good place to invest against inflation. So we just wanted to show you this graph, and it's just our reason why we do not invest in gold. If we were to invest in gold, it would be basically the bullion, and definitely not the stocks, because when we look at the fundamentals of a lot of the companies in gold, it's so expensive and they make rarely a profit. So we can see the tendency. Basically, it's just done the exact opposite. Now, granted, based on the low that they've hit this year, it spiked up a little bit, and I think this week was a little bit higher as well. So, but if you look at the tendency, it's not that great, in our opinion, a place to invest. That's why I wanted to show you why we do not invest in gold, and it's our opinion. A lot of people have invested in gold at a smaller percentage into the alternative portion of the portfolio. We just don't. So this is a slide that basically for the past 20 years, we've been showing in our opinions every single year, and more than once a year, every opinion that we give. We like to look at long-term rates. The reason why, historically, if we look at the cycles of rates, they were around 35 years, and we don't want rates to go up for 35 years because, as I told you, when rates go up, the value of the bonds go down. But we were used to the past 30 years to have interest rates going down. So the same is true. As rates go down, the value of bonds go up. So it was easy to invest in bonds for the past 30 years, more so for the past couple of years. And we can see now that the rates are starting to creep back up. It is a little bit not out of date. It's just we want to show you that cycle of 10. These rates are starting to come back up. So this slide to us is extremely important part of the portfolio management in terms of asset allocation, because the fixed income portion of the portfolio could bring us really interesting returns this year. The inverted yield curve, important to us. The reason why, it's one of the indicators that tells us if we are heading into a recession. So that's why for the next 3 to 6 months, we just want to be careful. It's been fun, the market, for the past month and a half. And that's why we need to be invested. It surprised us. Now, this said, this is an indicator that often 2 consecutive quarter of an inverted yield curve gets us into a slowdown or a recession. So we are currently inverted, which means basically that the short-term rates are higher than the long-term rates. Now, the blue curve was a year ago. And this is a normal curve. Now, it was a little bit abnormal because normally we don't have that those yields or those rates that are so low. But this is what a normal curve looks like. Long-term rates are higher than short-term rates. So looking to today, this indicator is really important. Canadian as well as US. Both are inverted, so that's an indicator to be careful. We can see that it's starting to flatten a little bit more in the US, but again, this we'll see in terms of a recession sign. That's one that's really important for us to follow. And actually, technically, there was 2 consecutive quarters in the US where the curve was inverted, and technically that's considered a recession. The good news is that the employment rate is so low that's why when you hear in the news, they have a hard time saying, are we in a recession or not? And we'll look at the job market a little bit later on. So credit spreads are bonds, fixed income, that are a little bit, that have a little bit more volatility, a little bit more risk involved to it. So what we're looking at here is those are the red line, investment grade. So without being too technical, investment grade are great companies. They're not government bonds, they're companies with solid balance sheets. Whereas the blue line are high yield. So the number that you see here, either in Canada or in the US, you can see that that's above and beyond what a government bond, which has no risk or very little risk in terms of not getting our money in case of bankruptcy. So the investment grade has normally 1.45%. We call it in basis points, 145 basis points higher than what you would get from the government. So, and then the high yield is 465 basis points, so almost 5% higher than what you would get from a government bond. So that's why in terms of diversification, there's risk, return. You just got to be careful how you manage and you adjust your fixed income portfolio. But there are opportunities to get a little bit higher yield. Because moving forward, 2 big institutional managers are forecasting for the next 5 to 10 years that the bond market, the government bond market, we should expect about a 2% return. With the inflation being high as it is, and not convinced that it's going to go back down to 2%, that would be, we got to be careful. That's one of the high risk of low rates on the bond market. So we need to tweak it a little bit when we adjust your portfolio. So are we probably nearing the end of the rate increase? We believe so. And we've showed it a little bit to you. Why? Because on the numbers of 7.7 in the US, we could see that the curve was starting to come down a little bit. Are we out of the woods yet? Not convinced so far. We got to be careful. We got to be aware for the next 3 to 6 months. It's not because the market has done very well for the past month and a half that we are all gung-ho and going into riskier assets. But the fact that the inflation is subdued, we believe that we're really nearing the end of the rate increase. It's already anticipated in December in Canada. It should be, but anticipation is a good thing because that means it's already in the price of the bond market. The surprise that could happen is that if the inflation is not quite under control, we should and will get higher rates. But I think we're nearing the end of the rate tightening cycles. So some of the elements that we look into, and I mean there are many elements that we could look into beyond these, but those are 7 items that are really important to us. I won't go through all of them, but we've looked into the inverted yield curve. The inverted yield curve, when we say yes, basically what it is, it's kind of a reddish sign. That means no good. So we are heading into a recession. Like I mentioned to you, it's 2 consecutive quarters of negative growth. But with this 2 consecutive quarters of inverted yield curves, gives us a sign that we are in a recession or we're heading in a recession. I will go back and look at this SM manufacturing index. This index is pretty important in terms of the economy as far as the manufacturing is concerned, as far as the companies, can they produce, are they in growth mode or are they in the slowdown mode? So the number of 45, it varies. Some people, sometimes it's 50. We look at it as 50, but some other institutional managers will look at it as 45. So between 45 and 50, that's the tendency that's important. And are we heading in that direction? So the reason why it says no is that we're above 45, and I'll show it to you. I will show it to you a little bit later on in the presentation. The positive inflationary trends, well, I guess there's we know that I mean, even if we did not know that, the news on a daily basis would tell us that we are into an inflation. We are. Those are big numbers. We understand the pain. It does cost more, especially when you go to the grocery store. We understand the pain. It's for us a short-term pain when you look at the greater scheme of managing the portfolio for the next 5 to 10 years, but it is a short-term pain as it is right now, and a negative sign in terms of recession. The tighter financial conditions, it's very neutral. Housing starts. Like I said, I don't want to start and talking about the housing start. Maybe we'll do a webinar later on about the real estate market. But for the time being, it's declining a little bit, but it's still not into we believe it's going to be interesting for the next 5 years, but we're not there yet. The labor market weakening, that's the green sign there, or light green in this instance, that makes it difficult to determine, are we heading in a recession or not? Our take on it is that it's positive to have a good labor market or low unemployment, but at the same time, it brings us a challenge of finding new staff or new employees in a firm. So we'll show the positive and the negative of this labor market, and the leading indicators, which is basically the stock market. It normally tells us that if we hit -20 or more in terms of drawdown on the market 6 months ahead of time, it tells us that we're heading into a recession. And we've hit -20 at least 3, maybe 4 times in the past 11 months. So what are the probability of a recession? I find that slide very interesting. Basically, it's 50-50. So are we heading in one? Well, as you can see, the tendency has gone up. So yeah, there's 50% chance of a recession. We believe that we're heading more towards a recession, and a recession is not always painful. It's not fun, but you'll all often hear me say it's a slowdown. But an economic slowdown or recession, it's pretty much the same indicators that telling us that will be a slowdown moving forward. So why we're showing this slide based on the recession is that there's a bunch of numbers here. Those are the recessions since 1973, which was in the news a lot in 2022 in terms of comparison. It's not really, you can't really compare the 73, 75 recession compared to today, just because of the employment that's so strong, which was not in the early 70s. But this said, what we're trying to show here in a balanced portfolio, is that the 12 months prior to the recession, the type of returns that we're expecting is 7%. During the recession, it's negative. Now, this said, if we look at 2008, which was the second largest recession, we had a major drawdown of minus 16%. And 2020, we're at minus 9%. So that's the portfolio. And again, there might be a little bit tweaking. You saw minus 10 is just because of the date sometimes that you're using and the certain index that you're using. But basically 12 months after, other than 2001, we had a nice surprise in terms of return. Why? Because we'll see there the market is discounted, and that gives us opportunities. If you're actively managing portfolio, it makes even more sense because you're averaging down, and on good companies, once you average down and they start to go back up, well, you've shortened the period of trying to get back to the same return that you had expected. I often use the example, if you have $1,000 and the market goes down 50%, you go down to $500. In order to go back to your $1,000, you need to get 100% return of your 500 to go back to 1,000. But if you average down and you buy that $500, you buy it more, or you buy it, put money again in the market, you bring it down to $750 average. And that $700 or $750 to go back to $1,000, you only need 33% return on your money just to go back to break even. So long story short, that's one indicator for us as well to just say, we feel your pain, we feel the emotions, we feel it's not fun when it goes down. Let's not forget that we're managing long term. Even though you're into retirement, we still manage long term. We make people die at 95 and 97. There's a reason for it, is that we manage the money to make sure that your savings, you have more savings at time of that than not. So the full period, when we look at the history, and I understand it's average, but it gives us a good idea because we often go back to average. We see the improvement, +7, negative, 12 months after, positive, and for the full period, so from the 12 months during the recession and 12 months after, we are positive. So we need to be patient. You need to be patient, but we need to be active in our portfolio, and that's what we're trying to do for you. So the personal consumption, and I wanted to go back to this a little bit because I mentioned it in terms of the unemployment or the employment rate. What's interesting here is that the current 3-month average versus the 3-year average pre-COVID, you see that the personal consumption has increased. So people are starting to be a little bit more optimistic, but they start to spend a little bit more. Makes sense if we look at the last portion of the graph here, where the wage growth has gone up tremendously. Now, this is where I wanted to show you the positive and the negative. The beauty of it is that there are a lot of people employed. They are spending, which is good for the economy. Now, this said, the power of the employees is in their hands right now because of the shortage of employment or employees. They can ask for bigger wage, and there has been a major increase in wage. The wage growth or the wages in a company is the highest percentage of expenses of all financial statements. So by default, when the overall wage grows up, the profitability of the companies will go down. So that's why when you hear and say, well, this company on a quarterly basis did not meet the expectation, it makes sense. And moving forward, and that's why we're saying for the next 3 to 6 months, we are anticipating that companies will not make as much profit. Now, you saw some of the largest companies do tremendous amount of layoffs. Will that happen? Will the unemployment rate goes up? We believe that it will somewhat, but the economies, the employment is fairly strong, and that's where we are a little bit on the yes and no portion of the personal consumption, the impact on companies. This said, rates go up, profitability goes down. But what happens is that I wanted to show you 2 things. The earnings growth, as well as the ICME, the manufacturing index. I told you about 45. The 45 is here on the graph. So there's two curves. The green line, that's the manufacturing, and that's the growth of the company, basically. So we see that the tendency has gone down a little bit. We're looking and expecting in 2023 to go down a little bit more early next year, but you can see that it's still above that 45 line. So we mentioned to you that we're looking at the 50. So we're still above 50, but we're right there currently right now at the 50 mark for the ISM manufacturing index. So the tendency is negative, but again, we're just at that place where will there be growth or not? Anything above 45, when the curves goes back up, that's growth. Everything that goes, that the line goes down, it's just a decline in the production. So the earnings per share, you saw that it's gone down quite a bit, and it just makes sense because higher wage brings the profit down. It's just plus and minus. So the revenues minus the cost will give you the net profit. A little bit too simple in terms of explanation, but that's basically what it is. So looking at this, again, that's another indicator. Of course, when the economy, the ISM, when the economy, the supply and demand is strong, when the demand is really strong, it's tough for companies to be able to build an inventory. So it's when there's a slowdown, we want to make sure that are they building back their inventories, and that's what it is right now. So they were not able, when the economy was too strong from 2021, it was tough to get to the demand of your product. So that's why the inventory was, I mean, there was no inventory. So the supply chain did not help, but basically now we're starting to rebuild a little bit. There's a little bit more capacity to rebuild the inventories of the company. So what does that mean for your portfolio? Basically, what we want to do here is we want to decompose the equity returns. There are really four elements in a performance of a stock. We will touch very, very shortly on the Canadian dollar, the effect of the Canadian dollar. Short term, it does have an effect. Long term, very little, very minimal. We often say, well, we like stocks that pays a good dividends. In 2020, when there was a major drawdown, we had great opportunities to buying stocks which had a high dividend rate because the stocks had gone down. But if you look at the blue portion of it, of the overall performance of an equity return, you can see that dividends is part of the performance, but it's not necessarily part, and it's all different markets, but it's not the main component of the return. The two main components are earnings. PE meaning the price earning ratio, and the other one is the future price earnings ratio, the earnings expected moving forward. Those are the four elements. So the blue, light blue, or gray, and red are the major part of what we can expect in terms of return. So when you see the price earnings below, that means that it draw down a little bit on the performance. So overall, the earnings are what's important. So where are we at in the stock market? So we're going to talk about the indexes. We're not talking about individual stocks in this instance, but when we look at the price earnings expectation right now, the average of the Canadian stock market, and it's the S&P TSX, it's around a little bit above 15. It's around 15 times earnings. Now it's at 12.3. Now these two lines here, without being technical, it's one standard deviation from the median. So basically, it's cheap. Now, does that mean that the stock market will creep back up and go back to 15 times earning and go up? Eventually it will, that's what we believe, but short term right now we're not managing, we're just building the portfolio. We want to make sure that we do have Canadian stocks in your portfolio. Same thing with the US. The US is, like I said from the get-go, is still the strongest economy. It's still the most representative economy in the world, but it's not as much of a discount as other part of the world. It could surprise us, but at the same time, it's not really cheap, but it's certainly not expensive. So we're okay, and we are neutral in terms of the US portfolio, of your portfolio. The rest of the world, the international portion of it, well, here is still considered cheap compared to the average. So here it's around 16 times earnings. We're at a little bit below 13. So again, there's an opportunity. Now, this said, for the past 2-3 years, that market has been a little bit cheaper than the average. And so we started to overweight early last year into the international portion of your portfolio to bring it down a little bit, because obviously the war in Ukraine, closer to Europe, had a little bit more impact. We're just on the sideline. We are invested, but we are a bit below neutral in terms of the international portion of your portfolio. And the emerging market, well, I was telling you about the 2 studies that of 2 institutional managers that we received, and the study shows that for the next 5 to 10 years, the highest expected return in terms of any market in the world is China and the emerging market. We know the lack of transparency in China. We know short term, it's been, especially right now, about the COVID zero in China. We understand that volatility out there. We are underweight emerging market, but it is a market that's cheap. Not very cheap, but it's cheap. So what we did is that we are invested in the emerging market. Some people do not believe in the emerging market. We do. We're just underweight. Normally, we would want to be at around 5%. We are about 2% right now of the portfolio. Small amount, but just in case there might be surprises. But let's go back to the bonds, because to us, it's where we're getting a little bit excited, because very rarely we've had 2 consecutive years of negative returns on the bond market. We will have, unless major changes happen until the December 31st, we will have had 2 consecutive years of negative returns on the bond market. So when we look at the past 3 years of the bond market, it's negative. We've not protected. It has not done a good job. If we would have been invested 100% in stocks prior to 2022, we would have done better return. Now the protection is there, and moving forward, we think that's going to be really interesting. And why do we think that it's going to be really interesting? It's because it's at the highest discount in the past 30 years. You know, when we say we like to buy cheap and sell high, buy low, sell high, well, at a 30% or a major discount, a major discount as it is right now. And I say discount because the market has done, now it's minus 12%, but it was at minus 16. We started to build on the bond portfolio, the bond portion of your portfolio, because it was too cheap. Was it too early? End of June, early July? We thought it was a great move in July because the bonds had done some positive return to bring it down August, September, and October. And lately, because all the rate hikes and anticipation seems to be into the bond prices, that's where we think if we are heading into a recession, in order to get the recession out, we're going to have the banks, central banks will have to lower rates. When? We don't know, but we believe for the next 12 months, rates are pretty much where they should be. For how long, we don't know, but to restart the economy, one of the best ways is to lower rates. And they've got, the central bank, plenty of margin to bring down the rates if ever we are into a slowdown. So discounted bonds, when rates go down, makes it the bonds to go up. So we're expecting decent return for the next 12 months. And as you can see, you'll see on the next slide, but I'll talk about the GICs because we do have questions. Basically, often people will say, well, Guy, the GICs are almost 5% now. All of your portfolios of clients that are with us, they have, we've bought in April a GIC, it was at 2.9%. Today we would get a GIC at 4.9. Why? Because since April, the rates have gone up. What this graphic shows is that whenever it's below zero, it's better short term to have invested in GICs. That's basically what it is. Granted, 2.9 like we did in April versus minus 12, it's pretty easy to understand this graphic. Now, how often does this occur? Not too often. Now, that's why we're saying that we are really discounted on the bond market. Buying a GIC for us, you will leave lots of return or potential returns on the fixed portion of your portfolio. GICs are great if you've got an objective of in a year from now, I want to buy this thing and I don't want that money to move. That to me is not an issue. That's fine. But long story short, today, because of the discount, we are certainly more interested in buying bonds than buying GICs. So this graphic shows all the types of fixed incomes that you own in your portfolio. So we're talking about global bonds, Canadian government bonds, credit that we're talking good credit, US bonds, US credit, high yield. What this says is that those in green was as of December 31st, 2021. Last year, these were the expected return from the bond markets. So pretty low, as you can see. The discount makes it really interesting. And that's what we're looking at right now because of the discounted bonds at types of return. Now, often when I show a graphic like this, people say, well, let's go with the high yield to get the highest return possible. Well, we're not there yet. We want to make sure that we are not heading into a recession, which could cause the high yield bonds to be, the spreads could enlarge a little bit more. And as credit spread goes up, it's the same impact as when rates go up. So when credit spread goes up, the bonds yield on high yield as it needs to go down, and they're a little bit more volatile. So we're underweight high yield bonds. We are really looking into high yield bonds right now, waiting for the opportunity to invest. But as a diversified bond portfolio, that's really interesting what we're looking at too. And it shows here, we've just wanted to do a comparison between the Canadian market, the S&P TSX, the Canadian index of the stock market. That dividend yield that we're getting right now is around 3.3%. Look at the investment grade, that's the IG stand for, that's the corporate bonds with great credits where you, if ever they would go bad, you would get your capital back. Look at the difference where the yield is right now. It's at 5.7. So instead of buying a GIC below 5, we have a yield on bonds at 5.7. And if rates go down, like we mentioned, that will be really interesting to see how bonds will go up. So, but versus a dividends, we're not talking about taxes here. Obviously, interest rates or interest, we prefer to have them into registered accounts because it is taxed at the highest marginal tax rate. But we can see a difference in spread of 2.3%. So that makes it really interesting. Not to stay away from Canadian stocks that pay dividends because it's still pretty good if there's a growth attached to the stock. But interestingly enough, the yield on bonds, it's really interesting as it is right now. So that's why we're saying that we're getting a little bit excited about managing right now the portfolio and balancing the portfolio. After a rate inversion, an inverted curve, which where the rates, short-term rates are higher than the long-term rates. If we look here, the blue and the brown, basically what it is that after that inverted rate curve, the next 12 months is a really good place to be to invest in bonds or to overweight or at least increase your portion of your bonds into your portfolio. And the brown is for the next 36 months. So 2 years of negative returns, very rare. We're going to get it most likely as of December of this year. So opportunities into the bond markets make it interesting. Risk reward make it very interesting. Obviously, this is our different types of fixed income again, but all this said is that the next 12 months, if we position the portfolio properly, could give us a nice surprise in terms of performance. So we talk about the US dollar versus any other currencies, but basically what we're showing here is that this is what the US dollar does. What does that do as a Canadian investor? Because obviously, if you own US stocks in your portfolio, you'll definitely have an impact on the currency short term. What we just did this year is when the Canadian dollar went from 76 or 78 cents down to 72 cents, we started at 72 cents to hedge. To cover part of the portfolio against the currency. That is a tactical move. This is short term because we know long term it has very, very little impact. So when we get asked the question often, are you going to hedge or not hedge? It's still a call. That means it's still a strategy that if you are on the wrong side of the strategy, you could lose money. For example, at 72, if it goes down to 69, like it once did, not well, a few years ago, then you're losing 3% or 3 cents on the dollar. So that's not necessarily great, but long term, we don't have that much of a concern about the currencies, that it be into Canadian versus US, Canadian versus the euro, and Canadian versus the pound. So all this, as you can see over the longer term, doesn't have much of an impact for us, and that's why often people will ask us or will ask me and say, "So what's your opinion on it?" I said, this is my guess. This is what's going to happen. We did hedge 75% of the portfolio when it hit at 72 and it started to go back up at 73, but it's still just a call. And we did it because it was, when we do this, sometimes we use that currency hedge of Canadian versus US as kind of fixed income. If we are right, which in this case we were from 72 to maybe 75 or 76, I haven't checked it this morning, but we are protecting and we're gaining a little bit on the currency. But again, it's a call and it's a short-term tactical move that we do, not long-term. So got to talk about the barrel of oil, obviously the Brent versus the Canadian dollar. We always talk in terms of Canadian because for the past, I think it was 10 or 20 years, it was pretty much similar to petrodollars. But the past 3 months, basically what it is that the blue line is the correlation versus the Canadian dollar versus the oil. The spread is starting to not be there. That correlation is not there too much. Just wanted to show this portion because often people ask us about what do you think about the price of oil will go. When it was at $115 a barrel, now it's at $80 a barrel. So obviously, as a Canadian investor, we know that the Canadian economy, there's 10 sectors, but out of the 10 sectors, 3 sectors represent 70% of the economy, which are the energy, the materials, as well as the financial sector. So oil has an impact. If we would have been invested more heavily into oil stocks, we would have done better return. That's why the Canadian market has been doing the best around the major markets around the world, simply because our companies and barrel of oil has given good earnings to petroleum or oil companies. So just a quick note on this. Going back to what I started saying, that we try to take the emotions out of the market. We found over the past 20 some years that the pension funds is the way to manage the money. I always say there's only one way to manage money. It's through asset allocation. We've used this process. We eliminate the emotions of the market through this process. We adjust based on current aspect of the economy, as we were talking today. So this is the Canadian Pension Plan, the CPP asset mix. Just want to spend a little bit of time where often, even though we manage through asset allocation like a pension fund, sometimes pension funds have certain asset categories that is very difficult for the detail because US clients are considered detail and not institutional. There's some certain products that are difficult to find on the market. And one of them is the private equity. So you see right now that pension funds, the CPP has almost a third of their assets into the private equities. Private equities, without going over too long, is companies that are not on the stock market. So they invest in direct companies, and as you invest in those private companies, you expect a higher return. The challenge for most people that are at a retail, like our clients are, or most of our clients are, is that on the retail level, these are not liquid assets, meaning that before you can get your money, sometimes you've got to stay in this product for a longer period of time. So people that are retired that would need their money to live off their earnings, we probably would not invest, or if we were to invest, would be a very small portion of the portfolio, because this is not money that's easily accessible. That's what private equities are. Now, this said, there are companies to institutional managers that we're looking at right now in terms of real private equities, because there are so many products out there that says private equities, but they're actually not quite pure private equity. So we are looking into some of the two products right now. We haven't decided after our due diligence which one we're going to include in the portfolio, but just be aware for clients of ours or future clients that it might not be applicable to you. However, when you look at the performance return, often in the newspaper versus your own portfolio, there'll be a little bit of difference because of the private equity. On this, where are we at based on the inflation, based on the interest rates? This is a balanced portfolio. So the right-hand corner tells us that actuaries have done a calculation and they say, well, a balanced client who wants a balanced portfolio should have 5% in cash. The fixed income portion should be around 40%. Canadian equity, US, as well as international equity. You see the numbers as well as others being alternative investments. So as you can see here, we're at 7.4%. The 7.4 is a little bit is accurate because we do have a GIC that we bought in 2022, and any GICs or any bonds that are less than 1 year goes under the cash or cash equivalent, because we believe that we will be able to get that money back within the shorter period of time. So out of the 5%, when we bought it originally in April, we were convinced that we would put that 5% and invest it in stocks. Right now, based on what we just said, for the next 3 to 6 months, we'll see how it goes. We do have 4 or 5 months ahead of in front of us to see where the economy is going, where we're tweaking, where the opportunities are, in which asset class that we should invest. So right now, if nothing else would move, most likely based on what we just told you, it will go into the fixed income portion, which would be above what the actuaries recommend us. We'll see. It's too early to call, and we're at a phase right now where we need to analyze where we're putting our money. You can see that we're a little bit overweight in terms of Canadian equity. That's what we call neutral. US, we are pretty much neutral, a little bit overweight. Foreign equity, it broke down into, I did tell you that we have emerging market at about 2.5%. So we're a little bit underweight international portion, but because of the emerging market, some asset allocation separate the international portion versus the emerging market. We do it, but in our system, we just include it into the foreign equity or international portion of the portfolio. We're a little bit underweight in terms of the alternative investments. The reason why we are a little bit underweight, because we are analyzing one product in terms of private equity to see where it would go under others, which product we're going to include into the portfolio. So this is where we're at. I hope it just makes sense. Just to give you an idea, maybe 2 months ago, we were about 30% of fixed income. So we really pushed up based on the opportunity that we see moving forward. So we're really excited finally for 2023, later part of 2023, of finally getting some types of a little bit clarity in terms of where the economy will be based on the inflation, based on is there a slowdown or not, and where the opportunities are. Because overall, and when we do as a discretionary portfolio manager, we always try to adjust the portfolio based on facts to eliminate the emotions and try to make it so that the return, you have a decent return to live off your earnings. This said, just want to finish with this. It's been a tough year. You've been really good at staying invested with us. We really, I say it's an awesome move. And this said, we never know what can happen. And that's one of the reasons why we say we want to stay invested into the market, because we never know when the surprise might be. General Powell yesterday was talking about, well, maybe we won't increase rates as much. We want to control inflation, but maybe not. Those are elements of surprise that sometimes pushes our portfolio a little bit moving forward. We were talking about minus 10% as of October 31st. At one point, a balanced portfolio at the worst time were about minus 15. Now we're about minus 8, minus 7, minus 9. So it's still negative, but being there, moving money within asset classes gives us a chance to have peace of mind for you, but peace of mind for us. And like I said, we never know what can happen. On this said, I should have mentioned from the get-go, there is a chat where you can ask a question and answer. I'll stay on for a couple of minutes to see if you do have any questions. I might ask Miriam to help me out a little bit, but until you write your questions, and I'll wait, like I said, a couple of minutes, we just want to wish you all a happy holidays. Moving forward, we will have a webinar on a monthly basis. It's on different subjects. As you know, we are portfolio managers, but we're also wealth managers. And wealth managers covers many aspects, financial planning, as well as accompanying you when you go to the notary about your will, because ultimately we start with the end in mind. We call it the prosperity blueprint. And there are 5 phases into the prosperity blueprint, but the 5th one is the transfer from generation to generation, transfer of your assets. And that's what we're trying to do and accompany our families throughout the years. So on this, to you all, to your family, may this 2022 holiday season be the best for you. On this, I'm going to ask Miriam or Claudine if there are any questions. I do apologize. I should have said that from the get-go. But Miriam, any questions in the chat?
No question.
No question. Thank you very much. So again, thank you all. Almost on time, a couple of minutes over. We tried to do this for an hour. So happy holidays to you and to your family.